Hello, I'm David Cassidy with the midweek market update. Today, Trafalgar Day, Wednesday the 21st of October. Unfortunately, there is nothing new to write home about so far this week, as the key theme impacting global equity markets is a familiar one. Coronavirus negativity is dominating sentiment as global daily new infection numbers continue to rise, and as a result, lockdown restrictions are being imposed across Europe. Additionally, the continuing US fiscal stimulus stalemate hasn't helped. Although, as we've said ad nauseum, the chances of a new fiscal stimulus deal being agreed before the presidential election on Tuesday the 3rd of November was always going to be a long shot. However, it is worth stressing that while the new coronavirus lockdown restrictions will undoubtedly slow the global economic recovery, they aren't as severe or widespread as the restrictions imposed earlier in the year. And as such, we believe it will only slow the recovery from the current V shape to one resembling a Nike swoosh. Additionally, again, as we previously stated, as a result, it is highly likely that governments and central banks around the world will mitigate some of the damage with additional stimulus packages. For example, no matter who wins the US presidency, we know we will get a new US fiscal stimulus package. In the UK, we obviously have the added uncertainty of Brexit. However, it is clear from comments by MPs over the weekend that Boris Johnson didn't fully shut the door on further Brexit talks with the EU, although we must now accept that we are clearly moving rapidly closer to the end game, where we are potentially going to lose in some shape or form the unlimited access we have currently to the single market. However, at the risk of again sounding Pollyanna-ish, Brexit, coupled with the economic damage as a result of the coronavirus outbreak, will, we believe, lead to the Bank of England, the BOE, easing monetary policy further with more quantitative easing and taking interest rates negative. This belief has been underpinned by this morning's UK CPI inflation data. As expected, while inflation strengthened by 0.4% in September, this was predominantly due to restaurant prices following the end of the government's Eat Out to Help Out scheme. But with the headline rate at 0.5% and the core rate, which excludes volatile items such as food and energy, at 1.3%, both remain subdued and are well below the Bank of England's 2% target. While we fully accept that US fiscal stimulus and UK monetary stimulus may not be the remedy for all our economic problems, combined with improving company profitability, it does provide a big positive for equity markets. Although, as we previously warned, equity market volatility will unfortunately remain elevated in the short term. And unfortunately, this morning, the FTSE is trading down over 1%. Economic data this week from China clearly demonstrates how quickly economies can rebound. Chinese industrial production jumped 6.9% and retail sales climbed 3.3% in September, while quarter 3 GDP rose 4.9%. This clearly puts China on track to have a larger economy at the end of the year than it had at the start. In fact, the International Monetary Fund, the IMF, is now forecasting that the Chinese economy will grow 1.9% in 2020. And to put that into perspective, the UK is expected to be 9.8% smaller, while the US is expected to shrink by 4.3%. Additionally, we have also had a positive announcement regarding a coronavirus vaccine. The US pharmaceutical company, Pfizer, stated it is hoping to get emergency use authorization for its coronavirus vaccine as soon as late November. Although this is not the same as approval, it does mean that the vaccine will be available for use. And of course, A vaccine will allow economies to fully reopen and thus speed up the economic recovery.